So I'm Matt McCullough, I'm head of sales at Aldermore. So my involvement today is really, I'm not a complete MEES specialist, but what I am, I think I am, I'm educated well enough around the landlord market, tenant market, and the buy-to-let arena. And going through some of these changes here, I'm hoping to answer some questions around the significant change that faces the landlordscape and lenderscape in the future.
Brilliant. And yeah, so what's your sort of initial reaction to the Warms Home Plan and how it affects lenders and Aldermore, what you're thinking internally?
So the first part of it is that the warm zone plan's given us a bit more clarity, a bit more certainty. You made a point before around the report doesn't specifically say are any of the interest-free funding available for landlords. I think the way to look at it doesn't specifically say anything's ring fenced for anybody. So I think there's an element of there that will start to strip out, or at least it will create some innovation for lenders to provide a potential solution for landlords in that space to develop. I tell you, the key thing for me, right, is that what this is going to do, right, is clearly drive us very quick towards regulatory compliance, right? It's a very short time frame. I saw an excellent article this morning, actually, from Louisa at Paragon that stated that very clear, there's like 2.5 million properties privately rented now, currently fall below the minimum EPC C required. Now, to get them to the standard, that means that there's going to be approximately 1,400-ish rental properties per day have to be upgraded to meet that EPC requirement. That's a lot, right? Now, if you think about the time frame it takes to get there, you're talking 1,700-ish days. There's not a lot of room for failure. The key thing is, though, right, that these improvements being done to get to the EPC C, let's say £5,500 worth of average costs, it's potentially costing each property to upgrade. That's £13.5 billion going back into the economy that wasn't there before, right? Now, that's without a potential increase in March of 5% VAT. So there's a lot of uncertainty, a lot of pain for landlords as well, because, the cash has to be found from somewhere. I understand that. But on the positive side, there's a lot of economical growth going into that from there. And also, let's think about self-employed entrepreneurs that are in this space now actively fitting on properties. And these businesses, there's an element for them to grow over the next few years as well.
Specialist lenders are going to have a specific role in this. So instead of just sort of the zero low interest borrowing, what else do you think? How do you think you could be supporting your landlords as that specialist lender, knowing that you're not going to be necessarily competing on those zero interest loans anyway that might come through from some of the larger lenders?
I think there's two areas to look at, really. I mean, the obvious one that everyone's already on the front foot with, and they have been for a while, is just proactively pricing landlords in the better quality stock space more proactively. So, you get the EPC A, B, some C products where you've got a slight interest rate reduction on the front end. Some people have called it greenwashing and all that great stuff. For me, I think the innovation starts with actually how you start to give more funding to people that have got better quality properties. Now, for example, right, so the interest cover ratio that every lender will adhere to when it comes to actually providing a loan to a landlord based on the rent is made up of all sorts of different variables, right? Now, to get that percentage, one of the variables in there is EPC rate and quality. So rather than just lower the rate and make it a fair market, I think there's some innovation there around stretching the borrowing for people that have got better properties, that are wanting to grow, that can either take money out of them properties, increase with an increased value, if that's materialized, to fund more improvements and or fund more purchases. So I think that should be something where we go. I don't like the remit of better product for better property. I like fairer product for everybody, but I like better processes for better property. And I think if that enables people to borrow more and more often because of an ICR flex in better quality stock, I think that's where we go. The second part to that, though, is one that isn't talked about enough at the moment. It's probably in the retention customer space and the product switch space, because everyone's thinking about new to market. We see stats around 50%-ish mortgages that are being placed, are EPC C or above, depending on where that data is sourced. I'm not quite accurate and reliable on that. But what I would say is that no one's talking about the retention of these customers. What happened on the back book? That's where it matters, right? Because lenders clearly, if they wish to securitize stock in future, get a better securitization process for better quality stock. So there's going to be a drive to retain better quality stock, or at least signpost how to improve current stock two better. I think there's more needed, but there's a lot needed there, definitely. I don't think people are talking about that enough. But again, you might know more than me on that respect.
Interesting. And I suppose just to sort of follow up on that as well, sort of stretching the amount of borrowing available, um, with a portfolio landlord, let's say they've got 5 properties that need upgrading, that's potentially 50 grand they need.
Yeah.
Is there going to be sort of stretch and like more flex in terms of like maybe they're highly leveraged at the moment? Like how are
Yeah.
you going to consider that?
But in theory, it happens today, but it's done on price, right? So if you take someone who, and I'll make this scenario up hypothetically, right? But if today's EPC B product was 4.8% interest rate over the 5-year period, and an EPC C plus is 4.9, right? That 10 basis points makes a difference if the rent just meets the ICR coverage. So that 10 basis points will always give someone extra borrowing if it's 10 basis points less. So that happens today. But like why should somebody who's got a B-rated property have essentially a cheaper mortgage rate? It should be that the rate is the same. They've just got a greater capacity to borrow based on the quality of stock, right? Now, clearly by 2030, all stock's got to be C anyway. So what do we do then? You can't just go, right, well, I'm just going to make everyone's that price, because there might be implication of finance, swaps. We're not going to go into that piece, but you can see the volatile. But what I will say is that I think we need to move away from just the price gaming. It needs to be process led. We need to start baking that in now and create, well, a new habit, basically.
More around risk. So how are
Yeah.
lenders assessing the risk now around these regulations, and particularly back book, but also new customers? Because I know, some major lenders, when the previous MEES came in, they wouldn't lend on properties below an E, for example. So
Mhm.
yeah, how in Aldermore, or maybe your general market view, how are lenders sort of approaching this from a risk perspective?
To be fair, we've been on the front foot for a while, because the EPC legislation, as you know more than most, is changed historically quite a lot in a short space of time. So everyone's already been in a space to try and get their house in order, so to speak. So in the current world today, every lender now, if not, I'm sure they will, but us as now, we are basically keeping a careful eye on our portfolio EPC distribution, right? That's not just on the front book, that's on the back book. What's changing? For example, we have a really good in life team that look after our landlord, after our highly leveraged landlord in the background. And these partners, they meet with their landlords every year to annual reviews, and as part of that process, they will undertake certain credit stewardship processes, such as what EPC ratings are certain properties, what state of repair are they, any valuation challenges we need to be aware of, not just for us, but for the wider portfolio that clearly our property is leveraged against if we've done a portfolio stress. So we're already on that front foot to see, what are we exposed to today should regulatory change as it is come our way. And then we do a lot of work around, what properties do we have now are currently classed as valid accepted, i.e. the exceptions process for the valid exemptions prior that we'd noted. I mean, given the the volume of consultation we've gone through and the changes, it's very hard to nail down a specific process for it. What I will say is, with this new approach moving forward, I feel that there'll be an aggressive stride forward to find more about retrofitting. I think that'll start to become very, very common, very proactive in the near future. And there's a reason for that as well, right? I want to go back to the prior point you discussed, is around the timings, around for the change, the small cost change, what type of cost it'll be to change certain properties to meet the requirements. And the one thing that we've just got to be mindful of, right, is that this is now also overlapping the Renters' Rights Act, right?
Indeed.
And
Yeah.
clearly, the one thing to be mindful of is that any business owner, landlord, or if you owned 12 franchise shops across various towns, if you are incorporating a new cost, that does start within the business, and that will start with potentially your product line, right? So for example, in mortgages, if swaps go up, guess what? Products tend to go up. The same might happen here, right? Cost of enhancing properties goes up, rent could go up. And I say could because in some areas it probably will, but how it does is very different today. Because with the Renters' Rights Act coming into play, that will now be a more elongated process and a more controlled process, which means that landlords do have to think more carefully and strategically about these changes, not just about the EPC regulation reform, but also rental reform as well. So I think that's something to be really alive to, both from a credit risk point of view, to make sure we're meeting the requirements, but from a strategical landlord point of view, to make sure it all aligns in line with both sets of regulations.
That's a really good point, actually. And we've done a previous webinar on the overlaps of all of this regulation as well. So, but that is a great point. This isn't sort of in isolation.